Today's video is the last in a series of videos we've done on companies that we think might benefit from the passage of the infrastructure bill currently being debated in Congress. Morgan Stanley wrote a report a few months ago that identified 3 sectors in particular that were well placed to ride what they said could be the supercycle effect of an infrastructure bill, namely basic materials, steel, and construction equipment. We ran with this story and identified 3 U.S.-based companies within each of these sectors to see if the story had been priced into the market, using a simple model as our tool for our quick and dirty analysis. In a previous video, we first tackled basic materials and concluded that the story was already priced in, except in the case of Eagle Materials, where there still seemed to be some upside. We then tackled 3 steel companies and discovered that the supercycle story didn't seem to be fully priced in yet, as all 3 companies seemed to have some upside potential. In today's video, we're going to look at 3 companies in the construction equipment sector: Caterpillar, John Deere, and AGCO. Our conclusion is that the story again appears to be priced in, except in the case of AGCO, which still looks cheap compared to its peers. Throughout this exercise, our analytical tool of choice has been a simple model, which allows us to translate this supercycle story into a set of explicit forecasts. The supercycle story suggests that with the passage of a potential infrastructure bill, certain sectors will enjoy increased demand for their products over an extended period of time, and perhaps even some margin expansion on the back of this increased demand. So we've taken this story and translated it into a set of generic assumptions that we've applied to all of the companies in our universe. This includes above-trend revenue growth forecasts for each company and stable margins at the high end of trend. So let's take a closer look at our models, starting with Caterpillar. Caterpillar is coming off a 2-year period of declining revenues due to lower demand for construction equipment and lower demand in the energy and transportation sectors, leading to a decline in overall profitability. Nevertheless, there has been a healthy rebound in demand across all of Caterpillar's business units in 2021, and analysts are now expecting revenues to increase by 18% in 2021 to $49.2 billion, and by a further 11.5% in 2022 to $54.9 billion. So we've plugged these consensus figures into our model as a starting point for our base case forecasts, and then have leveled out our revenue growth forecasts at 7.5% per year for the remainder of the forecast period. Margins have also declined over this period, so we're assuming that they recover to pre-pandemic levels over the next 2 years, and we've reflected this also in our forecasts. Caterpillar shares have been strong performers over the last 12 months or so, despite having pulled back slightly in the last 30 days. Based on our base case forecasts, our model is generating a fair value target of around $210, suggesting that Caterpillar is fairly priced at current levels. Moving on to Deere, we've taken the same generic approach to developing a base case set of forecasts for Deere. Deere was also affected by lower global demand across all of its business segments in 2020, with revenue declining by 10% last year. However, analysts are expecting a sharp rebound in sales over the next couple of years, increasing by 12.5% in 2021 and 11.2% in 2022. And we've again used these consensus estimates as a starting point in our model before stabilizing our revenue growth assumptions at 7.5% from 2023 on. Margins for Deere are healthy, despite a dip in profitability last year, and we're assuming that NOPAT margins remain stable at 12.5% over the forecast period. Deere's share price was a significant outperformer over the last 12 months, and our model indicates that it has perhaps overshot its fair value range. Based on our base case forecasts, our model is generating a fair value target of $241, about 30% below current market price. Our base case forecasts for AGCO follow a similar pattern as the first two companies, so I'm not going to go through them in detail here. The one difference with AGCO is that our model is producing a fair value target well above the current share price, indicating that despite the stock's strong performance over the last 12 months, there still may be some upside potential. And when we look at a few valuation comps, we find that AGCO indeed looks cheap compared to both Caterpillar and Deere. This is the final video in a series we've done on companies that operate within the infrastructure sector. The objective of the exercise was to use our simple model to put some real numbers to the Morgan Stanley supercycle story. And what we found was a bit of a mixed bag. I want to emphasize that the approach we took was highly simplified and generic across all of the companies we looked at. Nevertheless, we have been able to generate a set of base case forecasts for each company, and these forecasts in turn have allowed us to produce a fair value target for each company. Given our approach, we're not married to our forecasts. So what I'd like to do is to invite you to download the model, which I posted in the description below, so that you can go ahead and play around with the numbers yourself. Happy modeling.